When should you transfer to a Roth index fund? Is it ever a good idea to pay taxes on retirement funds sooner rather than later? The answer could be yes when it comes to a Roth individual retirement account. A Roth IRA is funded with post-tax dollars and qualified withdrawals are tax-free. The primary advantage of a Roth IRA is that your contributions and earnings on those contributions can grow tax-free and be withdrawn tax-free after the account has been open for at least 5 years. In other words, you pay taxes on funds deposited into your Roth IRA, but future withdrawals are tax-free. Furthermore, Roth IRAs are exempt from required minimum distributions, giving you greater control over your taxable income in retirement. So, who is eligible to contribute to a Roth IRA? If your modified adjusted gross income equals or exceeds certain limits, such as $140,000 for single filers and $208,000 for married couples filing jointly in 2021, you cannot contribute to a Roth IRA. However, there is a workaround. A Roth IRA conversion allows you to convert all or part of your existing traditional IRA funds to a Roth IRA regardless of your income level. So when is the best time to transfer to a Roth index fund? First, if you believe your tax bracket will be higher in retirement in this case, paying taxes at your current tax rate is preferable to paying taxes at a higher rate after you've retired. Paying higher taxes in retirement may seem improbable, but it is possible, particularly if you haven't yet reached your peak earning years or have significant savings in your retirement accounts. It may make sense to convert all or a portion of funds in a traditional IRA to a Roth now rather than later. Second, you should transfer to a Roth index fund if you want to leave the most money possible to your heirs. If you don't need to access your IRA funds during your lifetime, converting to a Roth IRA allows your savings to grow unaffected by RMDs, potentially leaving more for your heirs, who can also benefit from tax-free withdrawals during their lives. Third, you should transfer if you don't have a lot of tax diversification in terms of account types. That is, the majority of your assets are held in tax-advantaged accounts. Converting to a Roth IRA will provide you with assets that will not be taxed when withdrawn, potentially allowing you to better manage your tax brackets and enable more personalized tax planning during retirement. Lastly, you should transfer if this year you have erratic income streams and a lower than usual income. For example, you could own a company that made a net operating loss from non-passive income. This could be the ideal time to convert some funds to a Roth IRA with a low tax impact. If you decide that a Roth IRA conversion is right for you, you'll need to know when to do it. If you have a sizable balance in your traditional IRA, you may want to carry out multiple Roth IRA conversions over the course of several years, which is known as a systematic Roth conversion plan. A multi-year strategy could allow you to convert a large portion of your savings to a Roth IRA while minimizing the tax impact. For example, you could convert just enough to avoid paying taxes on additional distributions in the next higher tax bracket. Early in retirement, when your earned income begins to decline but before RMDs begin, can be an excellent time to implement this strategy. Making Roth conversions when you're about to file for Medicare and Social Security is one thing to keep in mind. A Roth conversion may raise your Medicare premiums as well as the taxes you pay on your Social Security benefits. You should also be aware of how you intend to pay the resulting tax bill. For a couple of reasons, we recommend paying with cash from outside your IRA. 1. Any IRA funds used to pay taxes will not accumulate tax-free gains for retirement, undermining the entire purpose of a Roth IRA conversion. Second, if you sell appreciated assets to pay the conversion tax, capital gain taxes may reduce the benefits of the conversion even further. Furthermore, if you are under the age of 5912 and withdraw funds from a tax-deferred account, you will be subject to a 10% federal penalty. You should also be aware that a Roth conversion cannot be reversed. You can no longer recharacterize or reverse a Roth conversion under the Tax Cuts and Jobs Act of 2017. There is no turning back once you convert. Converting to a Roth IRA does not have to be all or nothing. You may discover that dividing your savings between a Roth and a traditional IRA or a Roth IRA and a traditional 401k is the best option for you. Overall, converting to a Roth IRA may give you more flexibility in managing RMDs and may reduce your tax bill in retirement. But consult a qualified tax advisor and financial planner before making the switch, and work with a tax advisor each year if you choose to implement a multi-year systematic Roth conversion plan. Let it be known that in 2022, the annual contribution limit for Roth and traditional IRAs is $6,000. You can contribute an additional $1,000 if you are 50 or older. If your income exceeds the IRS income limits, you are ineligible to contribute to a Roth IRA. You can transfer funds from one Roth IRA custodian to another. The transfer is tax and penalty free as long as the money goes into another Roth account and no distribution is made to you.